Hi everyone, me, small investor here. Today we'll discuss Archer Daniels Midland company, ticker ADM, why I'm buying it and why you might also want to take a closer look. ADM operates in a cyclical market and its stock price reflects this, with financial performance fluctuating between strong and weak periods. Currently, the stock is in a downward trend, making it an attractive entry point if you're considering adding it to your portfolio. However, please note that this is not a financial advice. From its peak in 2022, the stock has retracted by 50% and it's now trading at around $50, with a dividend yield of 3.8% and a current earnings per share of 3.5. While these numbers may seem compelling, they don't mean much without proper context, so let's dig deeper. Let's first briefly summarize what ADM does. The company operates in over 200 countries worldwide and manages a network of over 700 facilities, around 300 food and fat processing locations, and 440 production sites. ADM is currently in its third cycle of sustainable growth, as outlined in its corporate presentation. A key focus of this cycle is improving production margins, leveraging innovations like digitalizing production. ADM's business is divided into three segments: agricultural services and oilseeds, its company's largest segment, accounting for 77% of revenue, followed by carbohydrate solutions, contributing 26% of revenue, and nutrition with 7.5%. Each segment is further divided into sub-segments, but I won't go into details here. For those interested, I've included a link to the company's presentation in the video description. So we established that ADM is an agricultural company. Before diving into the financials, I want to share an interesting observation. Let's compare the World Food Price Index to ADM's stock performance over the past 2 decades. Historically, ADM's stock has shown a correlation with the food index, which makes sense given ADM's role in food industry. However, lately we have this divergence as the food prices are moving higher again, but ADM's stock is continuing to move lower. This raises an intriguing question. Could ADM's stock be poised for a rebound, or is the decline tied to the potential issues like misreporting financials? Okay, now let's jump into financials. ADM reported a record revenue of $100 billion in 2022, followed by $94 billion in 2023, with estimates pointing to $86 billion in 2024. This represents 2 consecutive years of declining revenue, a factor contributing to the falling stock price. Looking at ADM's average annual growth rate from 2009 to 2023, we see a modest 2% growth. However, if we measure from peak to peak, the growth rate drops to just 1.4%. While this doesn't indicate strong long-term growth, it's worth noting that buying the stock near its cycle lows can yield decent returns, especially considering the dividends. Now, let's project the numbers forward. To project ADM's financials, I used analysts' estimates for the first 3 years. For revenue, I applied a conservative approach with zero growth beyond that. For EBITDA, I assumed a 4.4% margin, reflecting the long-term average, while analysts project 5%, which I find slightly optimistic. For EBIT, I use a 3% margin, slightly below historical averages. For cash flows from operations, I use 2 methods, one based on its relationship to revenue and the other based on net income. Both yielded slightly different results, but this provides a useful range for validation. I conservatively estimated capex slightly higher and I kept the free cash flow yield at a modest 0.5%. ADM currently holds $9.5 billion in debt and $1.4 billion in cash. Net income is projected to decline in the coming years based on averages of revenue, EBITDA, and EBIT figures. Using these numbers, we can calculate company's stock price with different valuation methods. In my valuation process, I use several methods to generate a range of prices. This method includes free cash flow models, free cash flow multiples, EBITDA multiples, and enterprise value to revenue multiple. For the latter two, I also compare the company's metric to industry average for a broader perspective. An 8% discount factor was applied across all models, and I incorporated a margin of safety, 20% for enterprise value to revenue multiple, and 15% for cash flow and EBITDA models. For the enterprise value to EBITDA multiple, I used 11.6 based on company's average over the past 5 years and 11 as the industry average. Similarly, the enterprise value to revenue multiple was 0.55 for the company average and 1.5 for the industry average. So now, let's go over one calculation. To start things off, I will show you the free cash flow model, so you can see how I calculate it, and later just show you the numbers from other models. In this model, we start with EBIT, from which we subtract taxes and capex. This approach tends to underestimate free cash flow, which is acceptable since I prefer to remain conservative. Once we calculate the free cash flow, we discount them back to today's value using the 8% mentioned earlier. And lastly, we calculate the terminal value. Now we add all up to determine the company's current value. Next, we calculate the company's debt and cash. For ADM, the result is negative because the cash generated over the next 5 years, combined with the current cash reserves, is insufficient to cover their current debt. As a result, the calculated value per share is also negative. We can also calculate the share price based on EBITDA. For this, we take the projected EBITDA for 2029, multiplied by an appropriate EBITDA multiple, and discount it back to today. Lastly, divided by the number of shares outstanding. The calculation results in a share price of $49. All other models work on the same principle, we are just using different numbers. The only outlier is enterprise value to revenue, where I simply multiply revenue by enterprise value to revenue multiple to get the enterprise value, which we can divide with the number of shares outstanding. We can do this for every year until we have data for. Now, if we go to the overview of all these calculations, we can see that we have quite a range of prices, from -$9 to $111, with an average of $54.48. And now, if we look at the industry and take into account all the calculations, we have an average of $51.28. So quite consistent between these two, but for different reasons. Now, of course, all of this can be changed based on the changes we make in the table. If my assumptions are correct, we can expect to make around 7% annually from this stock if we believe that the presented data is achievable and the buying price should be set at $50, which is again conservative based on the averages we saw. Additionally, we can include dividends and this bumps up the return to 10.6% annually. But here we assumed no dividend growth, which is unreasonable. Let me explain why. The company has maintained an impressive 50-year streak of increasing dividends, a trend ADM will most likely want to continue. In 2023, the payout ratio stood at 28%, and based on my projections, it is expected to rise to 52% in 2024, before decreasing to 45% the following year, assuming the dividend remains at $1.8. This suggests that the company can sustain its current dividend levels while still allowing room for future growth. ADM has guided for a payout ratio of 30 to 40% in 2025, which would require the company to generate more money than my current model projects in order to accommodate the dividend growth, again showing my conservative approach and solidifying the buying price at current levels. ADM's long-term track record, stable dividend growth, and cyclical nature makes it an intriguing investment at current levels. I've done my best to present a balanced analysis, but I am welcoming any thoughts. Did I miss any key points that might change my perspective? Let me know what you think. And if you like this video, please consider subscribing and liking it. And bye for now. See you soon.